Welcome to the covered call. It is options trading's first trade that you need to learn. So that's why we're calling it Options Trading 101. Stock options may sound complicated and scary, but the truth is they're really quite simple to understand. And once you learn a trade, you know it for life and you can use that trade to print money effortlessly in your account from then on. My favorite trade actually is the covered call. You might ask yourself why, and I will tell you why. It's because anyone with a brokerage, Roth, or some 401ks can trade this trade in just a minute or two. It also has a very defined risk profile, which we're going to go over. The cash that you get paid to enter this trade, you get immediately. So that's a really great benefit to it as well. Many traders like myself trade covered calls on a rinse and repeat system to generate cash to pay for everyday expenses, to grow their accounts, and to generate wealth. So let's dive into understanding this killer trade, okay? There's just a few fun facts I want to go over about the covered call that you might find fascinating and get you interested to watch the rest of this video, which I hope you will, because again, this is such a great income generator. You get to choose, as the seller of this contract, the duration of this trade. This means you can choose to get paid weekly, every 2 weeks, monthly, or even once a year. Maybe even many years in a row, once for many years in a row. There's a lot of people who do that. You can't lose money from this trade itself. You can only collect money. Okay, that's pretty awesome. Covered calls can limit your gains, but they can also protect against losses. I'm sure there's some people in the comments who are going to come out and say, that's not true. Would love to discuss that further with you, but this is most certainly a fun fact. And then you also need 100 shares of the same stock or ETF to enter this trade. So for example, we're going to talk about Amazon in this video. You need 100 shares of Amazon to enter a covered call contract. That can be shares that you already own on Amazon, or you can go out intentionally to buy 100 shares of Amazon to just enter a covered call contract. I do that often, okay? So those are some fun facts about covered calls. But let's get started on understanding the covered call from soup to nuts, okay? So the covered call is a stock options contract. It involves a buyer and a seller. We are the seller if we place a covered call on our shares that we own. And again, we have to own 100 shares of the stock or ETF to place a covered call. Okay, so in this agreement, in this contract, we are the seller. And what we are selling to the buyer is the right for the buyer to buy shares from us, our shares from us, if certain conditions are met. And we'll get to those conditions in just a minute. Stock options are all based on contracts, and most of them are based on the idea of having 100 shares of stock. Even if you don't have 100 shares, there are stock options that allow you to trade, but they're all based on the concept of 100 shares of stock, okay? So options traders that we are willing to sell these shares to, they're interested in getting our 100 shares of stock, and they are willing to pay us money to get that, okay? We also don't really know who the buyer is. We're the seller in this arrangement. We don't know who the buyer is, and really, we don't even care, okay? Our broker will align the buyer and the seller together, and that's all that we really need to know here. I think there's some people who want to know, like, who is this person? You don't need to know. It's not important, okay? So that is the first thing that we need to know. The seller. As a seller, we get to choose the term of the stock options contract. And there are two choices that we have to make here, two important terms that we have to make when we sell a covered call. The first is the expiration date. And expiration dates are usually on Fridays in most stocks. Some ETFs have multiple expiration dates in a week, but for generally speaking, most stocks have weekly expiration dates. They expire on Friday. Occasionally, stocks have an options contract that only expires once a month, okay? But for most big stocks, they have weekly contracts, and you can choose any Friday whether it's a week away, a month away, 6 months away, but it ends on a Friday. And that's one of the parameters you have to choose as the seller. The second thing that you have to choose as the seller is the strike price. And the strike price is trader lingo for the price at which we are willing to sell those shares for. Okay, so we have 100 shares. What price are we willing to sell these shares for? There's a lot of thought that could go into that, but we're not really going to get into strategy right now. I just want you to understand that you, as the seller, get to choose that. So you get to decide what you're comfortable with on the expiration date and also the price for which you will sell those shares. So you actually have quite a bit of power here and quite a bit of decision making that you get to make. So again, the strike price is the price at which you are willing to sell the shares, and the buyer is very interested in buying those shares for that price. Okay? So that's what the buyer is looking for. So the seller's why. Let's think about why would the seller want to do this? Okay, well, the really easy answer is the seller enters this contract to get a thing called premium. And premium is a cash payment, a payment that goes straight into your brokerage account instantaneously. It's like a little money miracle. The buyer makes to the seller to have the right to buy the seller's shares if certain parameters are met. Okay, we're going to go over those parameters in a minute. But again, sellers are in this because they want to get premium. And premium is an amount of money that the buyer is willing to pay the seller to buy their shares if certain parameters are met in the contract. Okay? All right, the buyer. Let's talk about what the buyer wants out of this. The buyer wants to enter this contract because they believe it's financially advantageous for them to do so. And you may go, what does that mean? Doesn't really matter, in my opinion, okay? And we're going to get into that in a little bit too, how it doesn't really matter. We just need to consider ourselves as the seller and what's best for us. The buyer pays the seller a premium or a cash payment for the right to buy the shares for a set price on or before the expiration date of the contract. So that's what's in it for them. They want those shares at that price on or before the expiration date. Now, I want to just talk real quick about expiration date, okay? The terms of this contract, they have an expiration date. So that means that if the stock moves around past the expiration date, you're no longer bound by this contract. It's done. It's finished. So the buyer and the seller have a set amount of time that expires on the expiration date, which they are no longer bound to the terms of this contract. Okay, so I told you we're going to talk more about parameters and what we get to choose as a part of entering this covered call contract as the seller and the writer of this covered call contract. So that is something, just so that you all know, that is something that is a common thing that people say. They say you write covered call contracts. You don't really write anything. You're just clicking some buttons, and I'm going to show you how to do it in a second. But if you are selling a covered call, you're a seller, but you're also a covered call writer. Okay, so that's some professional lingo there too. All right, so we are looking at Amazon, and we are currently in the Robinhood platform, which I love for its simplicity and its ease. I really do love it. I think it's so easy to teach on as well, which is another reason that I really love it. But there's all sorts of brokers out there, and find one that works for you if you're interested in selling covered calls. But I do like Robinhood quite a bit. So when you come into the platform, you have to type in the ticker, and we're looking at Amazon. So it brought up, I clicked on another button which says trade options, and then I came to this screen. Okay, and usually what ends up happening is when you come in here, it's selected on buy call. But what we would be doing is we're selling a call. So we are selling a covered call, all right? So they don't put the word covered in here, so just be cognizant of that. But since we own the shares, this will be a covered call that we are selling. But we click on sell call, and what we end up happening is that we are now looking at an options chain. This is what an options chain looks like. There is a date here that you can select. Right now it is December 17th, so we are looking at an expiration date that's 3 days away on December 20th. We're also looking at all of the strike prices. Remember what I told you what a strike price is? So here are the strike prices, and they're all listed in these $2.50 increments. So if we had just bought these stocks for $231.61 a moment ago, just to sell a covered call on it, what we would do now is we're choosing two things. Remember, we're choosing the expiration date, the date which we want to be bound into this contract with the buyer, and then we are also choosing a strike price, which is the stock price that we are comfortable selling these shares for. Since we bought the shares at $231, there's no problem with selling them for $232 if that's what you're into. There's no problem with selling them for $245 if that's what you want to do. There is an art and strategy that goes into this, but for right now, I just want you to understand the concept of this. There's many different strategies you could apply here, but you can also sell covered calls quite easily and make a good income from not having any strategy at all. It's true. So what I love to do is I love to go look at the call that expires about 3 weeks out, because the premiums there, it's very easy for me to show you how this can be worth your while to trade like this. Okay. So what we're seeing here is, again, the share price currently is $231.70. And what I would like to do is look at this $245 strike price. I'm deciding right now that I would be willing to sell these shares for $245 a share. And what I can do is I can see over here that there's a bid price. And the bid price says $1.26. That is per share. That amount is per share. Remember, we have 100 shares. So when we click on this, what ends up happening is this little dialog box comes up and it says covered call, which for some reason is cut off today, you guys. I tried to fix this before and it would not show me this, but it'll show us a little summary. So what it does is it summarizes what we're doing here. It says we are selling the 245 call with the expiration date of 1/3/2025. That's January 3rd, 2025. For a total credit of 122. That makes no sense, right? Until we press continue. And then it shows us that we have contracts, 100 shares each, one contract for the price of $123 per share. This says high fill likelihood. That means the contract is probably going to be very easily scooped up by a buyer, which is great. That this will sell in the day, most likely, and that the estimated minimum credit that we will get for this is $123.97. So $124 essentially to sell these shares for the $245 strike price. So here's an example. This is an example of a covered call. All right. I want you to also, I'm just going to take a screenshot of this to have, because we're going to come back to the PDF, the slides that I made just in a second, and look at the possible outcomes for this trade. We're going to look at the possible outcomes for this exact trade, because it can go one of three ways, and I want to make sure that you understand all three of those. Okay? I also want to make sure you can understand something else right now. If we want, we can change the expiration date. We don't have to choose the 245 strike, and we don't have to choose that expiration date. We can choose other expiration dates. We can choose selling these shares potentially in February and going with the 245 strike price and collecting $8.10 per share. Wow. Okay. We could also do something like sell the December 20th expiration date and sell these for $232.50 and collect $234 in premium here. So I'm sure your mind is rolling with options. That's the cool thing about options, is there's a lot of options, but I just wanted you to understand here that there are many different trades you can do within the covered call, and they all have different benefits and disadvantages, which we'll get into in just a second when we jump back to the slides. Okay, so let's talk about what happens now. First, though, let's recap what we just did. We just sold an Amazon covered call together. We went out and we bought these shares for $231.60, which was the market price just before we decided to sell the covered call. So we bought these shares with the intention of selling a covered call on them immediately. So again, the stock price when we bought them was $231.60, which means since we were buying 100 shares, We spent $23,160 on these shares because we're high rollers like that. Okay? All right. Then we also agreed by placing a covered call contract to sell those shares for $245 should the stock price go to $245 or over that strike price by on or before the expiration date, which was 3 weeks away. It was a date that it was in January, okay? And we're now in December. So we're crossing the year with this covered call contract. All right, so that's what we did. Now let's discuss the outcomes. And the way I see it, there are 3 possible outcomes here. The first outcome is that if the stock stays below the $245 strike price for the duration of the contract, we keep our $123.97 in premium, and we keep our Amazon shares. No one can take them from us. The buyer can't take those shares ever because the stock didn't go ever above the $245 strike price. That's just the rules of the contract, okay? The rules of the contract also say that we get to keep our $123.97 immediately. It comes to us immediately. It can never be taken away from us. So this is just one of the powerful things about a covered call is that you can collect this premium instantaneously at the front end of the contract and not the back end, which I happen to love, okay? All right, so in this instance, we're keeping our shares, which is kind of powerful, and we're going to talk about why that is in just a minute. Okay, outcome number 2 is that if the stock is above $245 on the expiration date, the shares will be bought from us from the buyer, okay? They're almost always going to be bought. I've only had one time in the thousands of contracts that I've ever written where the shares didn't get taken from me and bought from me. And that was just because it was a couple pennies over the dollar. And I think the buyer was like, I don't really want these. It's not worth it. Okay. But this is so rare. So count on these shares leaving your account on Friday and the cash showing up for those shares to be reimbursed for the amount that you said you'd sell them for. So they'll automatically leave your account on Friday for $245 a share or $24,500 in cash, and it will arrive first thing on Monday morning in your account. So it happens automatically. Okay, your broker does the selling and all of that cash deposits for you. In this outcome, we get to keep the $123.97 in premium, and we made $1,340 in capital gains. Okay, so this is because we bought the shares for $231.60 a share, or $23,160, and the buyer paid us $24,500 for them. So this is a really nice payday for us over the 3-week period of time. We made $123.97 up front, so almost $124 up front, and then we make $1,340 on the back end. So our total trading income on placing this covered call over the time period of 3 weeks is $1,463.97. And that's the kind of money that gets a lot of people excited. All right. And that is one of the reasons why a bunch of people trade covered calls. Okay. Now we are going to talk about the third outcome. The third outcome is that if the stock rises above $245 a share at any time before the expiration date, the buyer can buy the shares, and it'll just kind of like happen as a little surprise. Okay, you'll just be like, oh, the shares are right now, they're at $247.50. Okay, and boom, they'll just leave your account, and you'll be like, huh, that's weird. Where'd my shares go? Well, the buyer bought them from you. They have the right to do that at any point in time while you're under contract before the expiration date to take those shares from you, and occasionally they do. I do find this to be a rare occurrence. I will tell you at the end of this when they like to take them, because it's interesting. There's 2 reasons they like to take them. But let's discuss this a little bit more, because the outcome is really the same as in outcome number 2. In this outcome, we still get to keep the $123.97 premium, and then we made $13.40 in cap gains. This is because, again, we bought the shares for $23,160 and the buyer paid us $24,500. So our total trading income is $1463.97, but we got all that money sooner than 3 weeks. Sooner, which has a lot of benefits to it, right? So, and we're released from that contract early. All right. Now let's just talk about why somebody might do this on the other side. There's 2 reasons that I've seen. The first reason is because if they buy the shares from you before an X dividend date, if the stock pays a dividend, they get to take the dividend as well as the stock at that point in time. The second reason is because they see that the stock is on a tear. They just want to take those shares now to potentially do their own trade with them. So that's one or two reasons that they might do it. There may be more. One of the things that I see a lot of people getting really hesitant about placing covered calls is they're always so concerned about what the buyer wants out of the transaction. And I never evaluate whether I want to get into a covered call based on what the buyer wants. I don't care what they want. I just enter the trade if it's advantageous for me to do so. Okay? A lot of people like to think about this as like, who's the winner? Who's the loser? To me, that's absolutely silly, because the more that you learn about options, and if you become very advanced, you'll find out that oftentimes there are winners on both sides of the trade. All right, so let's do a quick recap on these outcomes, because I think it's important to highlight how much I love all of these outcomes. There's not a single one that upsets me. They all make me happy. And that is one of the reasons that I love options trading so much. The risks are clearly defined. I'm comfortable with them. And so let's go over this one more time. Okay, so outcome number one, we get paid the premium and we get to keep our shares. I love collecting the premium. That's why I'm in this to begin with, is to collect that premium. Okay, so that's income to me, and that helps me grow my wealth and it helps me pay my bills. So I love that. Also, I get to keep my shares. So I don't mind keeping my shares, because then I can just sell another covered call on those shares, which I look forward to doing again on Monday morning. There are other ways that you can kind of manage that trade too with a rollout. You might learn that from me later, but this outcome is great. So again, I get paid premium and I get the opportunity to go ahead and sell another covered call on Monday morning and make more premium off those same shares that I bought once. Okay, outcome number two, we get paid premium, love that. And then on Monday morning after the contract ends, we get paid for our shares and make that huge amount in cap gains. I put XXX here because when I wrote this PDF, I wasn't sure what it was going to be, but it was about $1,400, guys, that we made on that. It was $1,360 plus the premium. So our total trade was that $1,400. All right, so that's amazing. Cap gains, 3 weeks of time, $1,400. We spent $23,000 something. You guys do the math on what the percentage return on that is. You'll be blown away. Have fun with that. Okay, outcome number three. We get paid premium and we get paid for our shares and we get the cap gains before the contract ends. So like this one I like even more than option number two, because my money isn't tied up for 3 weeks. It's tied up for 2 days, 3 days, 7 days, 10 days. I don't know how many days. Depends on the buyer when they want to do this, if they're going to do this to me. Also, understand, this is rare. Doesn't happen very often, but when it does, you'll be kind of happy. You'll be like, oh, great. I have that cash back in my account now instead of weeks from now. And then when you do the percentage return on that trade, and you knew it would take even less time, the percentage return would go up amortized over a yearly basis, wouldn't it? So that's another reason that I love that trade. Okay, so all of these are happy outcomes. There are definitely ways that you can lose money trading stock options. And I'm going to show you that. I'm going to show you the risks on this next couple slides. So the risks. It can't all be roses, right? Okay. The problem isn't really so much with the covered call itself. The problems rely more on that anytime that we buy shares, shares can drop in value. So when we bought our shares for a 231, there's nothing stopping Amazon from dropping immediately after we buy them to 225, right? Nothing. It could drop to 180. We don't know. So that is a risk that we take on anytime we buy shares. Do I think that's a risk specifically with doing covered calls? No, it's a risk to buying shares. So I don't really know that it's worth blaming that on the option itself. But anytime that you buy shares, shares can dip in value. Now, this makes it extremely important to be good with your stock picks, because you do not want to buy shares that probably drop in value right away or at any point in time, right? But there's nothing to stop that from happening So that's why you want to be ultra, ultra awesome at picking stocks. And I want to invite you right now to follow me on my YouTube channel, where you can look at the series of videos called Investing for Financial Freedom. Watch those videos and it will show you how to make killer stock picks. Okay? So I really invite you to do that, because that will help your covered call game, in my opinion. All right? The second risk with doing the covered calls is that anytime we agree to sell shares under a covered call contract, potential gains are capped. Okay? This is the big beef a lot of people have with the covered call. And I can understand their perspective here, but we're going to get to that in a second, my counter argument, because not everything is super cut and dry with options or with trading in general or just buying stocks in general. So the theory here is that if we agree to sell shares at $245 per share and the stock rockets up to $270, that gain from $245 to $270 a share belongs to the buyer of the contract. That's why they bought the contract from you. They're hoping, that's one of the reasons anyway, they're hoping something like that happens. Okay? So, you should think to yourself, do I want to sell the shares for this amount? You should also think to yourself, am I any good at controlling FOMO feelings? Because that's really what it's about. Because I will tell you that oftentimes a stock like Amazon can rocket off to 270, but it doesn't stay there forever. A lot of times it might drop again and you can go back in and buy shares for less. So some people are like, I don't ever want to sell my shares because they'll get away from me and I'll never be able to buy them again. That's a legitimate reason not to do it. That's a legitimate reason not to sell a covered call. So my thing is like, never sell a covered call on shares you don't want to sell. The only reason you should probably be doing covered calls is because you understand that you are limiting your upside. You also might want to sell the covered call because you're doing it on a rinse and repeat system. That's what I do. I have a certain percentage of my stock options portfolio that I just sell covered calls on stocks in a rinse and repeat fashion with multiple strategies applied, and I collect income that way. And I found it to be more advantageous than not over a long period of time, and even instantly often. So if you want to learn more about how to trade strategy within the covered call and learn how to apply 5 different strategies to the covered call, and when to place the covered call and when not to, feel free to reach out to me. My email address is erica@abundantlyerica.com. My website is abundantlyerica.com. That's Erica with a C. I mentor on how to do this, and there are courses that you can join at any point in time to learn the covered call, and I certainly invite you to do that.